our penultimate panel will be on addressing risk and restructuring finance. Despite increasing widespread recognition of the importance of critical minerals in the energy transition, many companies developing critical mineral assets are struggling to access capital, as many of us know. And this is all the more concerning considering the 12 to 16-year time horizon that it will take between developing an exploration project into an operating mine. So this panel will highlight key financial challenges faced by the critical mineral sector, such as price volatility, geographical concentration, and market uncertainty. I'd like to welcome our speakers, Jamie Strauss from Digbee, Sarah Gordon from Satarla, James Whiteside from the National Wealth Fund, and Simon Garnder-Bond from TechMet. And this will be chaired by Jeff Townsend from the Critical Minerals Association. So over to you, Jeff.
Ladies and gentlemen, thank you ever so much for joining us. I've literally just run back from the London Stock Exchange, where there's another event on critical minerals. So it's hopefully I learned something there that makes sense to ask these guys. Quickly, whilst we position ourselves, I'd like to get each one of the panel to say who they are and where they're from. So we'll start with Simon quickly, and then we'll work our way down.
Hello, Simon Garnder-Bond. I'm the Chief Technical Officer at TechMet. TechMet's a private company that invests in critical minerals projects from mining, processing, refining, recycling on a global basis. We've got a portfolio of 10 assets at the moment, ranging from tin and tungsten mining in Rwanda to lithium-ion battery recycling in the States, and lots of various things in between.
Brilliant. Jamie.
Jamie Strauss, the founder and CEO of Digbee, which is a sustainability assurance solution specific for the mining industry, very much helped by Sarah at Satarla, and very much appropriate for the whole industry, but particular focus on the developers and the early producers.
Sarah.
Hello, everyone. I'm the same Sarah Gordon that spoke earlier on, but wearing a slightly different hat. So yeah, my name's Dr. Sarah Gordon. I'm a professor of practice at Imperial College and also CEO and co-founder of Satarla, that includes the likes of Critical Productions. So thank you very much to those of you who were interviewed today.
James.
I'm James Whiteside. I'm one of the banking and investment directors at the National Wealth Fund, which was recently rechristened from the UK Infrastructure Bank. I have sector responsibility for critical minerals and I'm actively looking at investing in several projects in the UK.
Brilliant. Well, thank you ever so much for being with us this afternoon. I wanted to start with turn everything on its head, right? So everywhere we go and we ask what the biggest issue to industry is we need finance, we need finance, we need finance. And I was just in a meeting with the Saudi minister who said to the rest of the room, come on, governments, we need to fund the $6 trillion that we need. To which the rest of the governments in the room went, ugh. So they don't quite have the same cash, it turns out. But I wanted to flip it on its head. And I wanted to think, okay, you guys as finance, what are you actually looking for in a project that's investable? Because we hear lots of companies come up and say, you've got this great project. What are you guys looking for? Simon.
I mean, aside from the obvious, you know, a good project and good management team, good location, good infrastructure, I mean, those things you say as read. The biggest problem, I mean, he was right, the Saudi minister, did you say? He was right. The biggest problem really, when you look over the sort of the prolonged period for financing any natural resources project, whether it's critical minerals or not, is essentially the volatility of the top line, I think. It's the volatility of the commodity price that you're focused on. And unfortunately for our little subsector of mining, where you're in critical minerals, the metals are very small. We've essentially invented and generated new demand centers for new uses for these metals. And so you're going from a very, very low point of a tiny industry to something that's more material, but still relatively small compared to bigger commodities. And so the volatility on the pricing is still, and it's going to be for a while, I think, much wider than traditional metals. So it makes it more difficult because financiers, like us to a certain extent, but then more on the debt side, find it just really unpalatable to when they look historically, even short history, something like the lithium price, it just becomes almost impossible to finance. So, especially when it's a small market like it is currently. So that is the main problem. And how do you overcome that? Well, I think actually that's a place personally where governments need to step in. I think that's where I think he's right. The Saudi minister is right. It means that you require some patience. You require a level of investment over a time period that often equity investors are just not comfortable with. And so I think that probably falls onto government or government bodies to be able to provide some financing for. It's something, I mean, it is essentially the main reason why the Chinese have gained a 20-year head start on us, is because they are able, as a centrally planned economy, to take that long-term view. They haven't done it to try and damage everyone else. They've done it because they said, well, this is going to require a long-term investment horizon, so that's what we should do. I think, I talked to various government people over time. We're co-investors in Cornish Lithium, and it's starting. It's good to see some of that support, but you do need to have that patience to go through that cycle. And whether that's really happening right now, I'm not sure. I mean, it's starting, but maybe it's just not starting enough. Maybe we need to kick them a bit harder.
Okay. Well, on kicking the government a bit harder, James, how you doing, buddy?
It's good that just before the coffee break we had Julian and Martin on, because commonly what we hear from all projects in the UK is actually the grant funding route is much better than it used to be. But the real valley of death problem in the UK is kind of growth equity post-pilot into full commercialisation. So we're looking to try and address some of those problems in the UK. And I guess as a bit of a background to the NWF, we were set up in July 21 as the UK Infrastructure Bank. And under the new government, we've had our mandate expanded and been given more money. So we did originally have 22 billion of capital, and now we've got 28 billion. We're different in that we sit between kind of government and the market. So we look to solve financing problems. So with Simon's at TechMet and EMG, we did our first preferred equity investment into Cornish Lithium, which is kind of at the far end of the scale, kind of just coming out of pilot stage and into demo stage, and looking to kind of support, de-risk some of that, especially on the policy landscape. And our aim is to kind of emphasize government policy through our investments. But we need and require private sector capital alongside us, a bit like for those who have ever worked for the EIB, except that we take more risk. And we will act anywhere in the capital structure that we're needed. So I was our first kind of preferred equity investment with Simon and his team at TechMet, and we just did our first capital markets deal in a listed investment in Invinity Energy Systems, who are a vanadium flow battery company, in looking to build a factory in Motherwell, which you may have seen. So our job is to help de-risk alongside kind of private sector capital and provide a halo impact that only government can. But we have kind of criteria for those who are potentially going to speak to me afterwards. So TRL 7 and above, kind of PFS stage, ideally matching capital or greater, and 25 million is our minimum ticket size. And we want to see a route to kind of full commercialisation. But we can take some of that early stage risk that in the UK that some of that capital pool is missing, which there's a lot of it in America.
That's really, it's really good to hear that there is that kind of funding now available. Jeremy's up there saying, yeah, this is all good. So well done, Jeremy. So one of the things you've both said, and I'm going to circle back to risk in a second, but there is a necessity for both private sector and governments to come on board. When we were involved in critical minerals in 2020, Kirsty will remember, we were told very much that, it's the market has to work. And the reality is, it is a broken market, and state intervention is now the new norm. That's where we are. Is that an agreement across the panel?
Well, yeah, I mean, I think going back to 2020 when COP26 that was hosted in Glasgow and mining was basically told you're not welcome here because mining has no role in the energy transition. Well, luckily, I think some people realised that was a slightly embarrassing stance to take. And of course, you know, to give everybody involved credit, and especially as well the CMA for everything that the organisation's done, we're now in a very different state. And I certainly remember conversations with different members of government where, yes, the stance was the market will sort it. And I think I said in a fairly punchy style, well, yeah, the market might sort it, but it's going to be too late by the time it will have worked out what the answer is. So given the fact that we've got climate change as the ticking clock that's injecting this at the moment, we need to move really, really fast. And so how do we do that? How do we inject? I mean, I think, Simon, to what you were saying, how do we inject that certainty into those investments, into those business opportunities? How do we do that? And what is the role of policy coming into injecting that certainty and taking away some of the risk that we might otherwise face?
Yeah, I think sometimes, I mean, it's difficult to disagree with anything that was said, but sometimes it's difficult, sometimes it's easier to go back and try and understand. I mean, I think we all, slight echo chamber in the mining industry of understanding the problem. We're at the end of a cycle, or hopefully we're at the end of a cycle. But in reality, a lot of other things have gone on with regards to the underlying challenges. We've had passive funds grow exponentially over the course of the last 20 years. We've had risk off in the sector, which has massively affected us. Small cap sectors have been decimated over the course of the last 7, 8, 9 years. And this fundamentally affects flows into, therefore, the junior mining sector. I think that has got to be recognized within what we're also trying to do. And then you've got a whole challenge of execution risk, which this industry, of course, has not covered itself in glory over the last 25 years. And it's that execution risk which, personally, I feel is one of the greatest challenges to encourage new money into the sector. From what I think we generally call generalists, which, you know, we've had 80% of the specialist money disappear over the last 15 years. Some of that is related to the cycle. Some of it relates also to the disinvestment in the sector. Generally, I mean, if you go back to the mid-1990s, the sector was trading, I think, on double-digit EBITDA multiples when Centamin got taken out on 3.5 times cash flow the other day. There's massive disinvestment. And what are we doing to encourage new money back into the sector, which has either not been here before, or in the case of some funds that have just exited, which we would have called specialist capital in the old days. So to me, it comes down to trust and confidence. What are we doing to raise the confidence, raise the trust in this sector to give people greater certainty or comfort that that equity capital is not going to be diminished? And if you take the, I think it was McKinsey numbers in 2018, hopefully it's improved since then, I think it is 80% or 85% of all development capitals have gone over budget and beyond time, and on by average 45% over budget. Well, that's wiped out the equity investor, totally gone. So that is not a good start, a good place to start from. But if we can begin to, and I come back to responsible mining, and I've just come from another conference just down the road, where they were just talking that sustainability is just good business. It's just good business. If you have a relationship with a First Nations group, for instance, that's like a marriage. Once you've got that done, actually it all becomes much easier. You get better employment, you get everything just suddenly happens. You get better power contracts, et cetera, et cetera. So if we can bring it back down to just doing good, solid common sense, but also to communicate that. We never had to communicate it before. The market didn't ask us to communicate it. If we can communicate what we're doing in responsible investment, goes into responsible development, which goes into responsible production and therefore responsible materials, that works into the supply chain. That gives people better confidence because we have a lower volatility or low frequency of risk and issues, which therefore results in higher confidence, and therefore we can begin to get more money back into this sector on a longer term basis.
On a longer term basis is an interesting one. I'm going to slightly turn that back on you.
Oh no.
No, we're making
really practice that.
It's fine. But okay, so it's about 17 years from from exploration through to operation.
As an average, where you've got a lot of projects which were, you know, like Resolution Copper. I mean, you know.
Okay, so what we got? How long?
Well, it's not 17 years. I mean, if you're backing a project for 17 years, you haven't done a very good job in your due diligence, in my opinion. So
Good.
I don't think it's 17 years, but it is a lot longer than people think.
Yeah. So how do we drive finance then? Because reality is, to speed up a lot of these projects, it's not the amount of time it takes to do a feasibility. It's about raising capital to drive this in, right? So how do we speed up finance into these projects when what we're seeing is, I'm not going to say a lack of trust, but some kind of issue where there is not that willingness yet to jump in and finance quick turnarounds from exploration to operation?
It's easy. Norway, Canada, and Australia have all said they're going to do accelerated permitting for critical minerals when they are deemed to be responsible. Now, they've got to prove that. I accept the fact that that hasn't yet happened. And it comes down to the permitters having the confidence and trust in those management teams that they are going to effectively deem to be responsible. And if we can do that, they are then not so at risk in their own jobs to do that. And so if you can increase the confidence, improve the execution, increase the confidence through common sense, basically, but good business through sustainability, then you're going to get a faster permitting, whether or not it's sequential or overlapping permitting, like they've suggested in Norway or other places.
I think all of those areas also have much better tax breaks for exploration and development than we do, and than most of Europe do. So if we're in a European context, we're concerned about our supply chain, which I think you should be if you're here. That's also an area where governments could step in. And, they don't have to spend money in this year's budget. It's essentially, it's future money. Let the next regime worry about it. But you could definitely make those changes now, and it would definitely help. It would accelerate. And, if you tied it up with that, what Jamie was talking about, a more certain timetable for permitting, it would definitely encourage people to go and invest more because, they'd have that greater elevated opinion of the risk of it actually going to make money.
But it's also as well, I mean, that 17 and a half years, or whatever stat we want to pull here, that's from once you've found something. Yeah. And the fact of the matter is you need hundreds of exploration projects out there in order to find that one thing. And so there are, again, other statistics where you go, it's either 100 or 1,000 to 1 is the ratio with regards to how many exploration projects you need in order to find one mine. And that either means that exploration companies are rubbish, or it means that we're not necessarily collecting the right data in order to be able to give us the indication of what kind of stuff do we need on the table in order to make a decision to be able to move something forwards. Why do so many projects fail? Often it's because all we've cared about has been the rock and the commodity that we've been looking at. And I speak as a geologist here. I love the rock. But actually, you could have the most glorious deposit of copper in the ground, but if you haven't understood what's going on the surface with regards to the environmental, the social, etc. aspects, then actually you don't have anything there. Mm-hmm. Now, it's not to say that you cannot go and extract those materials, but you might need to invent new technology or different ways of doing it compared to what we've had in the past. So it does come back to that risk equation, but also valuing slightly different data sets from as early on as possible. That is something right there that will speed everything up, because also permits are there for a reason. They're there to stop us from creating a massive disaster for the future. And actually, if we put more emphasis on collecting the right data early on and using that in our decision making, that helps policymakers, investors, etc., to jump on board with the right projects at the right time.
So,
well, we're a sole UK investor, so I mean, planning and permitting is not just in extraction projects; it's everything, as everyone would know. One of our enhanced roles is regular feedback to kind of central government, and is one of the key factors that comes up in all of the projects that we look at. And government are aware, but we'll see if there are meant to be changes coming forward next year about planning and permitting. Just kind of in the southwest specifically, I mean, that's an interesting one. It's got incredibly supportive local authority who our experiences are very forward-thinking. So even though we kind of sit as arm's length, we have quite close relations with them and have a local authority team who say the same. So our view is that kind of Cornwall themselves are at the kind of forefront about how to make things happen which is a bit different to some other local authorities potentially. But there's also the permit, as Sarah was saying, the permitting exists for a reason. Like, there's been some well-known issues in the UK with kind of permit failures and losing social license for projects. So they exist for a reason. But yeah, we are working with some of these projects to kind of speed up, we hope, the planning process in future.
So playing devil's advocate, look at that face, you're not happy. Is there a role for government, not just the UK government, but governments globally, to take a strategic investment, to take a punt saying, right, we are missing this from our critical mineral list, the one that's just come out with the arches on the outside of the arc. So, but we know we can invest in that strategically and bring it down. Do you think there's a role for that?
So that's not within our mandate, so I couldn't possibly comment. But because obviously it's UK taxpayer money, it's your money, my money that has to be spent on UK projects. But clearly the government, as in the earlier sessions, the Mineral Strategic Partnership and the Critical Minerals Alliance, and I mean the fact that we're even having this conference, this didn't even exist people weren't talking about this in 2016. So the Western Alliance are actually kind of upping their game to address this problem, when kind of extraction was a dirty word before.
Yep.
But as the National Wealth Fund, we can only invest in UK projects. But my understanding is that there are other departments and kind of funds going into third-party funds to look at some of these, particularly across the pond.
But I do wonder sometimes, I slightly ponder that whether, because where James and the NWF, sorry, I was going to call it UKIB.
Yeah, no, we've changed.
Well, it's very similar to the position of a lot of governments. And I'm talking about the stage of development here, and it seems to me that governments always want someone else to verify and to reduce the risk. And I know he's just mentioned our tax dollars, and my tax dollars too, tax pounds. But I'd be interested to see what you two think. Does it not, it seems strange to me, does it not seem that the government and tax money should be for the earlier stage, it should be for the higher risk stuff, shouldn't it? Shouldn't it be the earlier stage where private equity is hesitant? Because once you've done your feasibility study and once you've done your engineering and you know that it's actually de-risked, it's a lot easier to find private sector investment. We essentially need you less then, right? I'm not saying we don't need you.
No, I was just going to say...
I would just say if you were doing a curve of like the necessity of government intervention and in terms of like hard currency to actually fund projects, surely it's at the earlier stage.
Well, our view is that so kind of the grant funding is there to do that, because private investors won't even invest because there's no line of sight of return. Where we come in and kind of provide a cornerstone investment that upscales to commercialisation. So our kind of experience is the UK grant availability market is actually quite good. And then when they come to growth capital, that's where the real valley of death is in the UK.
Yeah, and I think, I mean, just to build on that as well, we've heard from earlier conversations on today. So, I mean, the UK government does invest in, for example, the BGS. So in terms of doing all of that work that goes on there, in terms of different forms of blue sky research, so all the way through that as well. But I think exactly as you're saying there, James, there's this valley of death that we are so bad at in the UK. We are not good at taking our startup ideas, whatever they might be, and getting them through into flourishing. We sell all of our ideas to other countries. We're really bad at making our way through that. And I think that is something there where it's not, I wouldn't say it's necessarily on the shoulders of the government, but actually it's on the shoulders of lots of different parties to have to come together in order to be able to get us through that.
And I think actually Innovate UK and some of the grants and the Automotive Transformation Fund, etc., have done a good job at getting into there. There's never enough money. There'll never be enough money unless you're in Saudi Arabia.
I just added, look, I think the fact that we're having this debate really is a question mark for the whole mining industry, is how we can deal with exploration, because it's definitely not working at the moment. But I think coming back to your original point is Northvolt went bust last week. And as a result of that, Portugal have now also said they're not going to do battery plant in Portugal. I think Northvolt were a significant share. Sorry?
Lithium refinery.
Yeah, lithium refinery. So the reality is we've now gone backwards on where we were trying to go as call it a Western democracy. And so from that perspective, to answer your question, it's inevitable that governments have to step in if they want to achieve the goal that they're trying to go to. But we were just talking to Mike White on the tube after coming out of this other conference, and the Minister for Mines from Ontario was talking really about Canada nickel. It's quite obvious who he was talking about. And the need to effectively get involved behind that, because that asset and sulfides of nickel and everything at the moment obviously can't be developed at the current prices, and they have to take a longer-term view. So to answer your question, the answer is yes, if you want to achieve the goals with which they're setting themselves. Is that the way we've done it in the past? No, but we've got to change, and we've got to transform, and we've got to effectively move forward so that we can become more nimble if the goals, the geopolitical, or not the geopolitical, but the goals of critical minerals are to be achieved.
And to do that, obviously, we need to make it de-risk that for government as much as possible. I was at Australia House the other day, and someone was telling me a little story. They went to a government, I'm not going to say which one, not us, don't worry. And they asked for funding, and they said, okay, go and get some private sector finance. And they were bringing this innovative processing in. And the finance said, no, we don't like brand new technology. So they went back, and they came back to them 2 weeks later. They'd spoke to Metso. They got some different, more well-established stuff that was 20 years old, got the finance. Do we have a problem there in that we're willing to finance what has always happened, but the reality is we need to finance what hasn't always happened if we're going to meet, if we're going to de-risk, if we're going to speed things up, push things forwards?
Well, yeah, if you take an insurance approach to calculating risk, you will never do anything new. And as a risk management professional, this is something here where risk is not just about trying to prevent loss, it's about trying to unlock the upside and find those opportunities as well. Risk is just about trying to take charge of some of that uncertainty that you might experience in your future. And this is a case here, especially in the world of, say, sustainability or ESG. My colleagues around me see me flinch when people just talk about ESG as being threat or something that needs to be managed from a downside. ESG is all about unlocking the opportunity. ESG is how we're going to achieve that just energy transition for different parts of the world, where unlocking those natural resources will bring or could bring a huge amount of development. So and suddenly it becomes a much more interesting discussion, and it's not a question of mining, it's not a question of unlocking those natural resources. It becomes a development project. It's a much bigger offering and value proposition on the table from an exploration perspective. It's much longer time frame, but suddenly there's a much bigger sales pitch with regards to why someone should maybe invest in a particular project. I don't know, Jamie, what you think.
No, I think. To slightly take it on from there, I mean, this sector, as all sectors, are in the process of transforming. And if you look at the power industry, it's massively transformed in terms of what it needs to produce, how it's produced, and in terms of quantum. If you look at the car industry, it's transformed because of the EV world. You look at the AI world, it's a huge transformation taking place, and every single one of those sectors demands metals to go forward. So it's just been interesting listening to so many of the people today in terms of how do we embrace that? How do we mitigate risk? But as you also say, that transformation allows us to open up opportunities, whether or not it's applying. And really interesting part, actually, also the minister in Ontario was highlighting how they're incorporating so many new training programs for younger people, effectively techies, to be into the mining industry and to inspire people to come into the mining industry and to open up that opportunity and to address the shortage of labor. So not directly to take on from your comments, but yeah, I mean, the opportunity of transformation is for all industries. It's just a matter of how you embrace it and to what extent. And I think this sector produces so many good things, whether it's schools or hospitals or jobs, indirect and direct. But we don't communicate that in a way that effectively creates the opportunity to take us from a 3.5 times cash flow ultimately to a double-digit cash flow, and also be perceived in society as well in a really positive way.
So I guess then if we strengthen the ESG of a project's early doors, it becomes easier throughout the process of doing that. And I guess when you guys were looking at Cornish Lithium, that was relatively easy, good ESG program. I can see Lucy at the top, she's scaring me, looking at me. So, but excellent ESG program at Cornish Lithium. So that made it easier for you guys to invest, right? One of the things I hear from people, and I have a little bit of a problem with, is people saying this last year has been so hard. The last 18 months has been so hard. I don't have a choice. I've either got to keep the project going or I've got to do ESG, and I can't do both. And the reality is getting the projects across the line is the most important thing. What's your thoughts on that? If we think that by doing an ESG compliant products, you're going to actually make it easier to find investment further on down the street?
Well, it depends what you're not doing, I guess. I mean, there's no point progressing a project if you're actively doing things that are negative for your environmental, your social license and everything. There's no point going forward at all, because you will fail. I mean, James said it's just good business. It's an essential part of good business. So if you can't do it in a responsible and sustainable way and a well-supported way going forward, then you have to pause everything. I don't think that's a decision you should have to make with a project. But that being said, I think a lot of the way that we treat those kinds of risks should be embedded in your business plan going forward. You're right, Cornish Lithium was relatively easy for us because they'd set out a very good platform right from the beginning and they were following it, but it's not something that, that's not done. I'm sure Lisa will tell you it's ongoing and it's always ongoing. But mining's always been that way. Maybe we haven't communicated it very well in the last sort of 50 years, and it's become more important in the last decade. But if you do that well from the beginning, it shouldn't be a drain. It shouldn't be a drag on the project. It should just be part of the project, and it shouldn't be a huge financial drag, because if a project is that tenuous, you're probably at an earlier stage where your ESG considerations are not huge expenses. You're not at that kind of like huge environmental study stage, which might be costly.
I think, Jeff, I understand why you've asked it in that way, but I think that's part of the problem. You've come at it from the negative. And the problem with ESG on a global basis, it has been cast in the negative as bureaucracy, compliance, and regulation. And yet, doing it because it's good business, whether or not it is having a really good relationship with your local community, whether or not it's reducing your carbon emissions, whether or not it is, frankly, putting up a solar plant, which in the case of Sentiment, the numbers might be wrong, but I think they save $20 million a year on diesel costs. Whether or not it means you're going to get faster permitting as a result of doing X, Y, and Z. All of these are the positives to address the issues which we've been addressing. And this is the problem. We're casting ESG in the light of the negative and bureaucracy and compliance, which I understand because that's how it's effectively evolved in the world. But if you turn it around and look at this industry from a position of what does it do, how does it do it, and for how long it has been doing it, this sector's up in the top quartile. And actually, if you look at the numbers on I think it's the European, I did this with a group last year. If you look at the sustainability numbers from MSCI Sustainalytics of the European quoted companies, they're in the top quartile of ESG numbers. Bizarre, completely against what we were expecting. But they've got the worst rating, the worst valuations. So there's a complete disconnect. So I think I understand why you asked it that way, but the reality is we're not embracing sustainability. This industry is behind the curve in terms of the way we want to communicate it for our advantage, and therefore we're pulling the sector back relative to what we can do with communities, finance, cost of finance, permitting, and frankly, every other aspect of the life cycle. And we've got to reverse this to being a positive rather than a negative.
And that's where Digbee comes in and helps.
Well, thank you. It wasn't intended to be entirely commercial, but we're trying to be constructive. Yeah.
And Sarah, one of the great voices on ESG in the industry. I mean, it's got to be the way forwards, right? If you want to feed into Western markets, at some point there will be legislation that suggests a certain ESG compliance. ESG has got to be the way forward. You might as well build it in from the beginning.
Yeah, but I mean, I think that this is where we're kind of at this crunch point, perhaps at the moment, because we're not seeing the premiums come through with the proof that somebody is doing it in the right way. There's a lot of talk about it. We saw earlier on this year, everything happening in the world of nickel, for example. And so this is a case where raw materials, of course, are inherently undervalued. So the prices are just too low for anything to be done with them. Now, the car manufacturer or whoever it is are quite happy with those prices being nice and low. So this is something around how does the whole supply chain actually come together to say, well, what is it that we're actually trying to build here? Yes, we can build the wind turbine, but if it destroys a patch of land in the process of doing that, is it actually worth it? On balance, how does this interconnection actually come together? And I think that this is where there's a lot of discussion around ESG standards and regulations, and there's a nightmare, there's a forest of different regulations out there. There are entire sectors that make all their money by doing stuff in this world, but that's not ESG. That's not sustainability. I mean, exactly as Simon says, actually it can be pretty simple with regards to what you're doing. So how do you integrate that into the space?
I would just say, that I think there are some companies which are showing, so you look at, there's a, now completely forgotten the name of the companies, but if you look at B2 Gold and a number of different companies which are quoted, and they'll come to my head in a second, but they've got premium valuations because they have a lower frequency of risk, which therefore allows them to have a high level of confidence. So I think it is beginning to come up, but it's not always been classified as ESG. But ultimately, it is the same.
Well, it's just, as we've already said, it's just good business.
Yeah.
It's just that we're perhaps shining a bigger light on those areas in an integrated manner. When you're doing your risk assessment or your risk profile for a board of directors or the company leadership team, that risk profile includes everything from your operational risks through to your finance, through to your environmental, your social, and they're an interconnected network. And that's what we need to be looking at here, not at those different areas of risk in silo, which is perhaps what's been feeding into people not investing in new ways of doing things in the past. So everything is interconnected.
I'm going to throw a question out there, and everyone hates me on this one, but I'm going to do it anyway. I don't think price premiums are going to work. And the reality is when I speak to the automotive sector, they say we want the cheapest product, right? So surely the opposite of that is an ESG tariff. To basically say, we can generally tell what an ESG compliant is, how much it costs. If you don't meet that, we're going to stick a 30% tax on it and make sure that the cheapest product is ESG compliant. Makes all our EV cars much more expensive, but it forces the automotive sector to choose ESG compliance. So I'm going to go from the end. Price premium or tariff?
Yeah. Well, the government have been working on the kind of the carbon border adjustment mechanism for a long time, so another hat I wear is kind of CCUS projects, and lots of that industry becomes viable on a base price of if there's a carbon border adjustment. And the UK is in an unusual position in that we still sell very high-end cars into China. So kind of unlike the EU, they're not as ready to ramp up tariffs. But we've, for a long time, been talking to colleagues in DBT and DESNZ about carbon border adjustment. So I think if they get that right, lots of the other issues will flow through from that. But it's a big problem to solve.
Well, I mean, this then comes down to market versus governments and policy in terms of which lever that you're needing to pull. And so, for example, again, looking at things like palm oil, there was a very big and public failure with regards to sustainability in that particular arena, where people were investing in a fund that said, no, we're making sure that this palm oil is coming from ethical sources, and actually it wasn't at all. Now, this is where, coming back to what Sarah Jane was saying earlier on, we have the technology to monitor this. We've had these satellites around for a few years now, okay, granted, not decades, but our satellites and that technology can help us actually monitor what really is going on. So it almost doesn't matter if it's a price premium or a tariff, but there needs to be that verification to say, is it actually real, or is someone just waving their arms and saying it's magic?
Simply answered, I think I believe in market forces, and I think the green premium, I tend to agree with you, But I think the best way it was described to me is you're going to get preferred supply agreements. And that effectively is a green premium. So if you're not on the preferred supply agreement, then you're going to get a discount. So in effect, that's market-driven, and it comes down to the established structure we have already. Granted, most of these off-takers don't fully understand how to fully incorporate sustainability into their things as yet. But I mean, nevertheless, preferred supply agreements have been around for decades.
Pretty much what Jamie said. Yeah, I think price premiums are just incredibly difficult to manage and maintain. And just if you're trying to pen in essentially an open market like that, it's just incredibly difficult to try and run efficiently and accurately. So I think more the latter. And I think Jamie's right. The projects that perform better in that regard are probably going to, or should attract more attractive financing, so should be more likely to be successful in terms of being built. I'll say one thing that on a sort of more global scale, where we're looking at the moment, when a lot of the prices of critical minerals are under pressure, and a lot of the reason for that is because suppliers come online from less traceable sources, let's say. One lesson we should be taking at the moment is that the customers don't actually care that much, it seems. They're not that bothered. They are more focused on price and only price. And that probably won't be forever, but that's the situation we're in now. One of the things that I've heard from some OEMs is that if they talk to big miners or larger mining companies who maybe aren't as well informed in the smaller metals that we're dealing in, they get reassurance that that don't worry about it. The mining industry will be able to come up with this metal. It'll be fine. It seems that that's quite self-serving because they don't want to be seen to be under pressure from either governments or their customers to be able to make changes. But I think that is happening, and it will happen. We just think it's just going to take a bit of time.
Fair enough. So with the last couple of minutes, I just wanted to point something out there, which is a lot of people have said the last 18 months have been exceptionally hard. I think, James, with the introduction of the National Wealth Fund and the new mandate and what you're doing, I think that has brought about some hope within the industry about what's achievable in the UK, the building of a midstream, etc. But do we think generally this slump has got another year in, or do we think get another 6 months out of the way and we're going to start seeing things move around a bit more?
I mean, from a first principles point, rates are high. So if you can get a tax-free return from the UK government in a year of 7%, and that is really, really difficult for private investors to crowd them on alongside you. So until rates come, I mean, that's the whole point to crush inflation. So I mean, hopefully, as rates fall, you'll see more appetite. But I agree exactly what Jamie said. The emergence of like ETFs that track metals on the exchange, and to an extent, kind of risk into cryptocurrencies has kind of crushed junior mining companies' ability to raise money on AIM and maybe ASX as well. It's been tough. So that's why we're working. And I know kind of the Australians and the Canadians are also working to find finance solutions. And we're in talks with kind of the US export credit agencies. So, I mean, the wider part of this, there's a whole series of packages out there from like royalties and streams, et cetera. But there's also the ECAs that people don't regularly think about unless the project's really big, that we're talking to and working with. But it has been difficult as rates have moved up, and it's not just in this sector, it's across all projects we've seen.
Yeah. I mean, I'm quite excited, actually. I mean, we've been really busy the last few months, and I think if you look at the sector, I mean, development projects are getting funded. It's not as easy as people want it to be, but they are getting funded. No, and I mean, I think also there's a bit of a realization in the mining industry. I think there's actually a feeling in the mining industry that perhaps we can never get back to where we want it to be, and usually that's the bottom. So I think there's a lack of belief at the moment, but projects are getting financed. It's not extensive, and the critical mineral explosion, or whatever you want to call it, it was always going to be a compound growth. And we are seeing, copper earlier this year did have a big spike up as a result of TCRCs and other things, and Panama, obviously. So I think there are signs that it is getting better, however difficult it is. And I think there's a lack of belief at the moment. And I think the vision for this sector is so exciting because of what we've been doing for the last 20 years. We just need to, and it goes back to what I was saying earlier, but to communicate it better and to give more confidence and trust to some of these investors who can come in. And actually, there's a number of them who want to come in now. But I just don't think they've quite got that switch. We're close to a switch, and we haven't quite flicked it yet.
Okay, well, on that, ever the optimist I am, let's leave it with, we want you all to believe. I want to thank you all for your time. James, Sarah, Jamie, Simon, thank you ever so much. I think we've had a really good discussion.
Thank you very much.